Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's the 7th of September, 2023. It's a Thursday. A little bit different set as you see here. Got a very special guest. I think this might be our first three-time guest that we've had on. One of the good friends of mine. We have a lot to talk about. We're diving into the market. We're going to talk about some sectors and the reason that we believe this is the start of a great bull market. Joining me today will be Brett Eversole, editor of True Wealth Systems. All that more coming up right now on Making Money.
NVIDIA may be America's top performing stock after more than doubling this year alone. But if you're holding NVIDIA or thinking of buying it to get a stake in the $7 trillion AI market, you're going to want to see Mark Chaikin's new AI prediction first. Mark is a regular in many news outlets from Fox Business to CNBC and built the stock indicator Wall Street uses to find winning stocks. His award-winning system flashed buy on Tesla before it climbed 335%, Moderna before it climbed 300%, and Riot Blockchain before it climbed 10,090%. It also found NVIDIA at the start of 2023 before its massive bull run. But right now, Mark is stepping forward to warn people to stay away from NVIDIA. My system has indicated that NVIDIA is no longer the best stock to buy to profit from AI, is what Mark says. In fact, it just flashed buy on a totally different AI stock. And today, he'd like to hand you the name and ticker symbol of his number one AI stock to buy right now. For the limited time, you can get this information for free at www.aifrenzy23.com. Again, that's aifrenzy23.com for a free copy of his new report.
Again, this is Matt McCall. Thanks for joining me. It is September 7th, 2023. And as I mentioned, good friend, very smart guy, not too bad looking either. Brett Eversole sitting across from me. Brett, thanks so much for sitting down with me here today. So you've been on the show a lot, and just to give people a little background, I think I may have done this last time, but you and I met several years ago, and your old colleague, or our old colleague, Steve Sugar, used to do a lot of these things, still a colleague, I should say, and you learned under his wings, which he's one of the greatest investors I've ever met. And Steve and I did a lot of things together, and now you and I are. And I always find it funny because you and I have had a lot of discussions years ago, like literally 3 or 4 years ago, probably before COVID, talking about how we kind of had the same view on the market. And we found over the years that always, people in our company would put me over here and you over there. Matt's crazy, aggressive, and Brett's very conservative. And we found we actually agree probably on 80% of the big picture things. And then we pick stocks a little differently. But let's talk about that, because recently we've both been extremely bullish. And there's more people joining our camp, but we're still an outlier. We're still, you watch financial news, even a lot of our colleagues, right? I'll call out Dan Ferris, again, a good friend of ours, but I think you called him a curmudgeon recently, but a great guy and a very positive guy outside the market, but still extremely negative. What's really turned you around? Because you're not like me. I'm more of a Optimist, majority of the time, bull most of the time. You'll go back and forth. You let the market tell you. What is driving you to be bullish right now?
Well, first, thanks for having me, Matt. It's fun to do this in person for the first time, and always happy to be back and chat with you. Like you said, I do think that we come about things in a different way, but we often end up at the same endpoint, which I think is interesting because we have those different paths. But for me, it's pretty simple. Last year we had this massive bout with inflation that caused the Federal Reserve to spike interest rates. Like this story is old, and I'm sure your audience has heard it a million times, but that was the problem for the market the entire time. So at the start of this year, I looked at things and stocks were starting to rally. The bottom was in October, and inflation was starting to come down. And in my mind, it was like, okay, all of the problems from last year are kind of solving themselves. When, whether it was inflation was more transitory than we thought, and that's why it was coming down, or it was the Federal Reserve policy. Either way, inflation was coming down, and those problems of higher rates and kind of a resetting of valuations and of expectations, those problems were starting to solve themselves. So I was pretty bullish at the start of the year. And then what I saw as the year went on, I think either the last time or the time before that we spoke, earlier this year, there was just like a really powerful market breadth that was working in our favor. And what I mean by that is it wasn't just that the market was going up, but lots and lots of stocks were going up. And most any indicator that looked at market breadth, you were seeing that happen. And so
let me cut you off, because I'm going to play devil's advocate here. because the headlines over the last 6 months or even year to date have shown or tell you the exact opposite. They're like, well, the Magnificent Seven, the big 7 tech stocks, they account for 75% of all the gains in the major indices, year to date through the first 6 months, let's say, of the year. So you're saying something different, though.
Yeah, so at the start of the year, that wasn't really the case quite yet. So at the start of the year, we had a pretty broad rally, and then it really did narrow down to where these few stocks were moving higher. And there was an expectation, I think, by most investors that this should be a bad thing. This has to be a bad thing, right? So if a few stocks are going up and everything else is kind of flat, you expect that there's going to be a kind of a catch down.
Yep.
Like those big stocks that are going up a lot are going to come down. There was a piece written by a guy named Brian Belsky. He's, I want to say, the lead strategist at BMO. I might have his title wrong. And he wrote a piece in May or June that basically showed that over history, when you have that kind of bifurcation in the market where a few stocks are doing well and the rest are kind of moving along, you don't get a catch down from the big stocks, you get a catch up from the rest of the market. That's really what we saw kind of start to happen in the summer, and then we've had a little bit of a sell-off in the last few weeks. But I think when you've had a pretty brutal bear market that happened last year, it changes investor psychology. People start looking for problems. They start looking around for what's the next boogeyman? What's the next thing that's going to bring the market down? And so for a time it was the Magnificent Seven is the only thing going up. Nobody dug in and did the work, but they just assumed, well, those stocks they have to come down at some point. When that happens, the market's going to be toast. Hasn't really happened yet. I don't expect it to happen. And at the end of the day, it's very simple. When the market's going up, it tends to keep going up. Like
momentum, right?
Momentum is, I do a lot of much more complicated research than that. But at the end of the day, if you're going to pick one strategy and just follow it, in my mind, it's momentum because it's unemotional, simple, and it works very, very well.
And when that momentum begins, it usually lasts for years. It's not short. And this bull market is not even a year old yet. So we're in very early stages. And you also have to keep in mind, it's about 78% of the time over the last 100 years, the market goes up. Mm-hmm. So you're kind of going with the odds. Momentum's going. You're almost going to be right 8 out of 10 times.
Yeah.
I'll tell you what, there's not many things in life where you can be right, almost 80% of the time. And most things are coin toss in life.
Yeah, I think generally in life, but especially in markets, it pays to be an optimist.
Yeah.
It's really kind of is that simple. Warren Buffett's basically said that kind of thing for his entire career, that, the long-term perma bears, like they're betting against American exceptionalism. And that's not a bet I don't think that's a bet you'd want to make.
Well, the thing is, they may be right at some point, with a big picture, but that's going to be a time where America really falls. And I don't care what you're in money-wise, life's going to stink. Does money really matter at that point?
Yeah.
And then you have the guys who call for the end of the world, and that happens once. And again, when it happens, money's irrelevant, right? So I always like to call those perma bears, they're worse than broken clocks.
Yeah.
A broken clock's right twice a day. They're usually right once a decade.
Yeah. Because
you do have typically a pretty nasty bear market once a decade or so.
Yep.
So they're going to be right. What people, I think, forget a lot of times is they'll go on TV and people who back them and say, he or she called that bear market. Well, they've been calling it for 5 years. And how much money did you miss out on in a 5-year bull market? It could be 200-300 times your 200-300% gains.
Yeah.
So net, unless you're timing it perfectly, you're probably going to end up underperforming the market by trying to be that bear.
Well, and then also too, it's a question of conviction. So, Michael Burry has made himself very famous and has been making himself maybe infamous in the last few years with his Twitter rants and such. But famously in The Big Short, he got short mortgage-backed securities, and he was losing money on that trade month after month after month for, I think, about 2 years. And to his credit, he had the conviction to hold that trade through, and he was able to stave off his investors from pulling money from the fund. To do that, that's a very hard thing to do. Yeah. So even if you believe in the idea right now, do you believe it in 3 months when it hasn't worked, and in 6 months, and in a year, and in 2 years, and you're losing money and opportunity cost of making money all that way up? Yeah. So to me, it's it's very easy to make investing hard. My goal is to make it simple. Like you say, the market's up 7, 8 years out of 10. Yeah. Why would you want to fight that? Why would you want to fight that? And then that doesn't mean you're just blindly optimistic, but put history in your favor and then go from there. And if you want to become a little less aggressive, you can do those sorts of things. That's fine. But to try to get...
You can't fight the numbers. The stats are there for literally over 100 years. So
exactly.
You can't fight that. But for some reason, this day and age that we live in, this world, people tend to lean towards the negative and look for things wrong. Like you mentioned,
for yourselves.
The Mag 7 being up, right? Somehow they took a positive story of NVIDIA hitting $1 trillion, this breakthrough we're having in AI, and he turned it negative.
Yeah.
Somehow the media turns what is a great thing and turns it negative. But you mentioned conviction. I think that's really important. For me, I get a lot of grief a lot of times from people because I tend to try to be very early into an investment. And I've been sometimes really early. And, he goes sideways or down for a year or two. But I feel good about it. And there's sometimes I'm like, you know what, I was wrong. That trend's not going to happen. But I usually feel okay holding it, Brett, because again, I'm betting on innovation and technological breakthroughs and really just the world getting better every single day that we live here. And again, that's been happening for thousands of years. You're not fighting that. Being a bear trying to time that market, you're trying to pick a black swan event, which the whole reason it's a black swan event is because nobody knows it's coming, right? It seemed like a really terrible strategy, but we'll get off the bears because I will go on what they call Matt McCall rants soon. So we'll get off the bears. So let's get back to the market, right now. Do you think this is a sustainable long-term bull market?
Yeah, I definitely do. I mean, like I said, the market has been, while it narrowed for a while with the Mag 7 driving the market mostly, it has broadened in the last few weeks, and really as it's kind of intensified. Similarly, if you kind of split the market up, I don't have the exact numbers, but I think roughly those top 7 stocks are around 30 times earnings, and the rest of the market's at around 16 or 17 times earnings. Now, it's funny because historically, maybe 16 or 17 times earnings doesn't seem that cheap, but if you look back over the last 30 years, that's below the average. I think the average is closer to 18 or 19 times. We kind of had this switch in long-term market valuations that began around 1990, which is really when the tech sector, as we know it, kind of existed. And I think a lot of people look at that and they assume, well, this is not long-term sustainable. What they don't realize is, if you look at S&P 500 margins, like earnings margins, they were around 6% in 1990, and historically they'd never been above 8. It was kind of range bound from 4 to 8, something like that. Right now they're 12 or 13, and it's been a steady march higher and higher and higher for that entire time. Basically, this is the way I think about it. The S&P 500 is this is the big leagues. These are the best companies. They run the most efficiently. They have the biggest markets. They have the best workers, the best executives. They are the big leagues. Yep. And they are the best at making money and at making changes to their business to improve the way in which they make money. And they can smosh out small competitors. And you don't have to like this thing, but it is a reality of how the market works. And so when you see those profit margins continue to increase over and over and over, I think it's partially because these companies get more efficient, but also the quality of the kind of company that can exist in the S&P 500 is just so much better today than it was 30 years ago. And just completely night and day versus what it was 50 or 60 years ago.
Well, you consider too what the companies were. You go back to the 20s, 30s, 40s, 50s. They were manufacturing something,
heavy
whether it be
manufacturing.
Steel, then autos, but they were manufacturing. Services was a very small part of the economy now. Where you look at, today, services are a huge part, and then you have technology, like a software company.
Yeah.
A software company, like Microsoft's a great example. You build a product, and then you just basically mass produce it. You spent the money to build it, and then you just deploy it out. And so productivity increases dramatically, your margins increase dramatically. And again, you make a good point. You go back to 1990, look at valuations then to valuations now. Companies are completely different.
Yeah.
They're squeezing more out of their employees. They're squeezing more out of every dollar they spend, every dollar they make is getting squeezed, which increases the margin. So you really shouldn't look at what the PE ratio was, in my mind, in the 70s or 80s and compare it to where it is today, because it's a completely different economy.
Yeah, I agree. Yeah.
So looking forward, again, you're a long-term bull, but you talked about valuations, and I saw the same number. It's 16 or so that the 493 other stocks in the S&P 500 are at. But you still will turn on CNBC or the financial media or another podcast, and they're going to say things are so overvalued. The CAPE ratio or this or that. There's always something. The CAPE ratio to me could be one of the worst ratios ever.
Yeah.
That ratio, oh my God, I'd say for 15 straight years, they've been telling me the market is overvalued. What's the market done over the last 15 years? It's basically gone straight up outside of a couple little pullbacks. So,
well, I think at the bottom in 2009, the CAPE ratio hit 12 or 13, which historically cheap is 6. It was so fundamentally.
And you couldn't get any cheaper than that.
Yeah,
I mean, that was the world was falling apart at that time.
Yep.
So you and I are getting together September 12th.
Yep.
We're going to sit down. We bring in a moderator for us to keep us on,
on task.
Because we tend to sometimes float into other discussions.
We don't want
rants as I do.
Right?
Exactly. So we're bringing in a moderator. We're going to sit down, and we did something pretty amazing recently. Why don't you talk about what we put together our portfolio?
Yeah, so we put together a portfolio of 10 stocks, 5 from you and 5 from me. And I think what we've tried to do is look at what's been happening in the market. This is a new bull market. People don't really necessarily want to believe that in a lot of cases. And like you said, the financial media was just always looking for a boogeyman, looking for a reason to pop that balloon. But in reality, this is a new bull market. And I think as investors, you can either get upset with that fact or, bury your head in the sand, or you can take advantage of it. And so you and I have tried to hone in on what are the stocks that we think, what are the stocks from what sectors and what stocks in those sectors are going to profit the most, not just over the next 3 months, but over the next 2 or 3 years. Yeah. The stocks that have the potential to go up, 2, 3, 4, 500, maybe 1,000% over that time. So we've put together a basket of, smaller companies in those sectors that have big growth potential. And these are definitely lesser known stocks. They're probably more expensive than a lot of people would prefer to pay a lot of times. But in reality, when you look at history, the biggest gains come in small companies that are relatively expensive. And you get those biggest gains when new bull markets are kicking off. And that's exactly where we are right now. The crazy thing is, it's not that new. This bull market started in October. That's when the bottom of the market happened. We don't know it's new for a while, but this has been going on for a year.
We're still like I mentioned when we opened this, we're still the outliers. We're contrarian to what the mass market's thinking right now, which, you may agree with me. I love that. Yeah. If we were sitting here right now and everybody else in this room, the camera crew behind us and everybody else, all of our colleagues, when we sat down in our meetings and everybody was bullish, that concerns me. Yeah. It feels good at first because everybody's, we're all together, but it truly concerns me because every time that's happened in my career, you're at or near a intermediate term top. Yeah. It's just how it works. And, until everybody kind of gets on that page, that could be years from now. Yeah. And I got to tell you, I hate to say this time's different because you never want to say that, but I kind of feel like we're never going to have, I shouldn't say never, the odds of having that mass of everybody being positive may not happen anytime soon because there's such negativity about politics and geopolitical concerns, wars and everything that's going on, inflation, high interest rates. I feel like it's going to be tough for everybody to be, where they say the shoe shine guy's giving you a stock tip. Yeah. I don't see that happening anytime soon.
Well, it's also we just had a moment somewhat like that in 2021. Yeah. I don't know, I wasn't around during the dot-com boom, but from what people tell me and from what I've read, 2021 felt a good bit like that, 2020 and 2021. And historically, those kind of moments don't come back to back that quickly. Yeah. And what's interesting to me is that, as this year has gone on and as the market has gone up a lot, I think at one point the NASDAQ was up about 50% this year. Yeah. Investor sentiment has started to turn over. And if you look at surveys and things like that, folks are starting to get bullish, both mom and pop investors and professional investors. But they're not really putting their money where their mouth is. Yeah. I mean, money market assets are still at an all-time high, I think almost at $6 trillion. Exactly, yeah. Retail money market assets, you can split that out. And that increased by about $1 trillion from last year through to this year. And so you've seen massive flows into bond funds, generally flows out of stock funds. People might be getting more bullish as time goes on and as the market goes up, but they're not buying. Yeah. And to me, this is just a flood of cash. And eventually, we're going to get that same kind of FOMO trade. It won't turn from this to the shoe shine guy telling you about stocks overnight, but it'll happen. It'll take, 12, 18, 24 months. Yeah. But that flood of cash is the kind of thing, it's trickles and then floods. And that's what can really push the market a lot higher. And to see the market rallying as much as it is right now, even without that happening, I think is a really, really bullish sign for the next 2 or 3 years.
Yeah, and you and your team, we talked about the melt up for the last 10 years, right? And you nailed it. You completely nailed it. And this is a very similar situation where you'll have this melt up because you're going to have money coming in from the sidelines, and that's an enormous amount of money. And eventually interest rates will come back down. Yeah. I don't think they come back down to where they were a couple of years ago, basically zero. They will come back down where it's not attractive to sit in cash anymore. No. At the same time, the market's going up, so it has to, because again, it's opportunity cost. Yeah. You have to move that in there. So we put together 10 stocks, 5 from your team, 5 from my team, and they match perfectly because again, not to be stereotypical of us, but mine are a little bit smaller, a little bit more aggressive, if you will. Yours still aren't Mega caps, though.
I think the biggest is maybe around 10 billion.
Yeah. So, I mean, that's almost like mid cap range, right? A lot of those, so you fall in there. And you think about that, how many, what's there, $7 trillion companies right now? If you're buying a stock that's $1 billion and it truly is on the cusp of, coming, it could go to a $10 billion company and still be very small in 10x.
Yeah.
And, the whole 10x thing, I used to get irritated when people talk about it. I'm like, have you ever had a 10x? And not to pat myself in the back, but I will. And these are documented. These aren't just me telling somebody at a bar. These are documented over 50 10x in 15 years.
It's crazy.
And I'll put that record against anybody. I mean, I don't think there's a lot of people out there that have done that. Between that and then the system that you guys have built, you put millions of dollars into building this system, True Wealth system. I really think we're bringing the best of both worlds together here and using it and giving the average investor out there, the individual investor, sure, institutionals probably buy our stuff, but we're going out to the average investor, Brett, and giving them research that I feel, you don't get. I mean, you're kind of like pulling back the screen, right? And seeing what goes on behind the scenes. So I'm super excited to do this. And again, this is something that you and I have been really kind of working on behind the scenes for years, or thinking about for years. What's the one thing that really kind of, when you leave here and say you go home, talk to your wife, your friends, and just kind of gets you excited about the next couple of years?
I mean, I think it is, and this is kind of more in your wheelhouse because I don't follow these things as closely. I kind of start from the top and work my way down as opposed to starting from the bottom and working up. But there's just massive innovation trends that are happening right now. I mean, AI, I think AI is probably overblown in the way people think about AI, and that there's not going to be like sentient robots walking around anytime soon. But AI tools are, I believe, the next push for efficiency. And so you think about, like I was talking about, profit margins going from 6 to 12%. AI is the kind of thing that could help push profit margins from 12 to 18 over the next 10 years. I don't know exactly how it's going to play out, but these kind of tools are going to be integrated into every big company that exists. And guess what? Like I said, the bigger companies are going to be better at integrating them, and they're going to improve their efficiency even more. And you kind of get this virtuous cycle. As companies become better at making profits, investors are willing to pay more for those companies. So not only do profits increase dramatically, but the multiples people are willing to pay increase dramatically as time goes on. So you get this virtuous cycle of earnings going up and valuations going up and earnings going up and valuations.
We saw that through the 2000s, right, with software.
Yeah.
Software companies, some of the best performing sectors in the market over about 15 or 20 years. I mean, just, you think about software, it's just a great business model.
Yeah.
But they have always been, if you look at just pure valuation, some of the best software companies, some of the best performing that in the last 20 years in the market, trade at, at their height a lot of times, 30, 40, 50 times sales.
Yeah.
Times sales. But they kept going up because really it comes down to you're paying for a good company.
Yeah.
A good company is not going to be on sale very often. It does happen from time to time. We get lucky, we're able to buy them. But
on sale is a relative term too, right?
Yeah.
That's the thing. Like a company like that going to 10 times sales might be cheap.
Exactly.
But if you're a Buffett style value investor, you never even sniff at that company or even think about it. But the reality is, the thing about it too is that it's very different from like the .com boom, where you had a lot of relatively faux businesses, regardless of what they were as stocks. They just weren't good businesses. They were bad business models wrangled around .com lingo. And in today's day and age, you might have some expensive companies, but these companies are bringing in real revenues and they're earning a very large amount of profit given that amount of revenue. And so those valuations, maybe they're kind of hard to justify if you're used to 1980s valuations, but we live in a different world today. I think you just kind of have to accept that. And as long as that growth continues, those companies are going to do incredibly well.
And if I hear the comparison of the AI rally we've had this year to 2000, 2001 again, I'm going to throw the TV through the wall. Because it's, like you just mentioned, a lot of those companies didn't have revenue. Not that they weren't making money.
Yeah.
They didn't have revenue. It'd be like you and I having an idea and going public.
Idea on a napkin.
That's burning money every freaking day. That's not NVIDIA. NVIDIA is printing cash right now.
Yeah.
I mean, their growth is insane. I'm not saying you run out and buy NVIDIA or anything right now, but these are real companies that are truly changing the world. And so what we picked, you and I went and we picked small mid-cap companies because these NVIDIAs of the world, the Microsofts, the Apples of the world, they do business with a lot of other companies. And a lot of those are small mid-cap companies that may have some type of AI tools that they use to help the big ones. Yeah. So, we're capturing kind of that next iteration of this technological revolution we're seeing coming up by going into small mid-caps.
Yeah.
Again, I'm not saying go sell the Mag 7. But I think we're going to do much better in the small mid-cap stocks that we've come up with, the basket that we've built, versus going at NVIDIA. And could NVIDIA be worth $5 trillion in 5 years? Heck, could be. I have no idea.
Yeah.
And get 5x from here. But I think you have a better chance of making 5x with some of these small mid-cap companies we came up with.
Yeah, I think that's totally true. It's just, it becomes a runway problem, right? Like kind of the law of large numbers. And we've learned that, like when I started in this business a little more than a decade ago, kind of that 300, 400, 500 billion number, it's like, well, companies can't really get bigger than that.
Yeah.
It's like, well, they can, they just have to grow into getting bigger than that. And we've seen that happen in the past 5 or 6 years. But again, like you say, if you're looking at a $5 billion company that maybe has $1 billion in revenue, like it's a lot easier to go from $1 billion to $10 billion in revenue than to go from $100 billion to $500 billion.
Exactly.
The world's only so big. There's only so much money sloshing around.
Yep.
That's just kind of a reality of the situation. And so, yeah, I think those are kind of the sandboxes to play in if you really want to make a lot of money in the next few years. But I mean, just thinking a little bigger picture, this is kind of like, this is a new bull market, and people seem to be fighting that more than I would have expected. But as an investor, you have to look at that, and you can fight that or you can accept it. And once you accept it, then you get to move forward and figure out how you're going to take advantage of it. Because if not, it'll pass you by.
It will pass you by. And again, not to give myself a pat in the back, but in 2009, my second book came out. It was called The Next Great Bull Market. It made me think as we were calling this the new bull market.
Yep.
And I got to tell you, that was not a popular book title at the time. People thought I was crazy. The publisher was Wiley, and they're like, this isn't going to sell anything. Nobody wants to buy stocks right now. I should have known right then it was the best time to ever buy stocks in 2009, which led to a 10-year bull market after that.
You're probably glad you didn't change the title though, right?
I did not. I think I had to rewrite the book, but it ended up working out okay. But hey, listen, man, thanks for coming on as always. Great to sit down with you.
It's a pleasure.
It's always good to kind of bounce ideas. And just so everybody knows, Brett's going to be coming on a lot more often now because I want to pick his brain. And I always feel smarter after sitting down with you. Most people in life you sit down with and you're like, man, I feel dumber after having that conversation. I will say, Brett, you're one of the few people in the world I sit down with, and I feel good and smarter walking away. So thank you so much.
I was for the same. Thanks, Matt.
All right, thanks. All right, folks. Once again, this was Making Money, Matt McCall. Don't forget to check out the 12th of September. Brett and I are sitting down with a moderator talking all about this new bull market that's coming. We're going to give you all the details. We're going to talk about those 10 stocks that we put together with our two systems, and we'll be presenting them to the public for the first time on the 12th of September. So don't forget, click that, tune in, and we'll see you then. But thanks for tuning in. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.